Okay, hello everyone. This is Group 16. Today we're going to talk about the use of derivatives in the airline industry during the pandemic. And here are our group members. This is the content about our jobs to work as a group.
Okay guys, here's about impact of COVID-19 on the airline industry. First is about the revenue decline. Since airlines globally saw revenue plummet due to travel restrictions, broader closure, and the significant drop in demand of both leisure and business travel, domestic air traffic halved immediately following the lockdown announcements, down from about 8,600 to 4,400. The suspension of domestic Jetstar and Air New Zealand services means 95% of domestic passengers' flights have now stopped. The second is about health and safety protocols. Airlines implement strengthened health measures such as mandatory masks, enhanced cleaning protocols, and promotion of contactless service to restore traveler confidence. However, this increased the operational costs.
Now I'm going to discuss the use of derivatives during the pandemic based on fuel hedging. Due to travel restrictions, the airline industry had to reduce flights and suspend operations. Reduced demand for fuel lead to dropping fuel price and excess fuel hedging. There are hedging adjustments during the pandemic. The first one is the use of call option. Air New Zealand used call option as their key derivative for hedging. During times of high uncertainty, option was more flexible compared to future contracts and swaps. With call options, Air New Zealand had the right, but not the obligations, to purchase fuel at a predetermined price. This allowed Air New Zealand to benefit from falling prices while hedging the risk of rising prices, which helped to maintain flexibility. The second one is scaling back hedging. There is a reduction of hedge volume to avoid overhedging and unnecessary financial losses. The third one is short-term hedging contract. The hedging contracts had a maximum term of 12 to 18 months. The shorter duration reduced the impact of overhedging during reduced demand fuel. The last one is flexible hedging contract. Air New Zealand hedge within minimum and maximum bandwidth, declining wedge structure. Air New Zealand set minimum and maximum levels for how much of its fuel needed to be hedged. The declining wedge structure indicated that the airline had hedged a larger proportion of its short-term fuel requirements and a smaller proportion for later months.
Currency hedging is a financial strategy that helps companies protect themselves against fluctuations in exchange rate. Companies use tools like forward contracts, options, or swaps to lock in exchange rates for future transactions. The purpose of this strategy is to provide protection from the risk of exchange rate changes, ensuring that company can stabilize its cost. Hedging allows business to focus on their core operations without worrying about how currency fluctuations might affect their profitability. Conclusively, companies can stabilize their costs, protect foreign revenue, and ensure financial predictability for long-term projects. This allows them to focus on their core operations without being impacted by fluctuating exchange rate, which could otherwise harm profitability. The below image mentions that Air New Zealand's hedges works well, with no ineffectiveness reported. This suggested that the hedge successfully protected against exchange rate fluctuation in cash flow. The table also shows weighted average contract rate for Air New Zealand outstanding foreign currency derivatives as of the reporting date in 2019 and 2020. By hedging this risk, Air New Zealand avoided unexpected loss from exchange rate changes, stabilizing its costs and revenues, ensuring more predictable financial outcomes in their reporting currency. which is New Zealand dollars. Air New Zealand uses forward contracts to manage its currency risk, which is crucial because major expenses like fuel are often priced in foreign currency. This is significant for airlines given that fuel and major expenses are often denominated in foreign currency like United States dollar for fuel. Air New Zealand's hedging strategy was effective in 2020 during the pandemic time, helping manage its risk in the market and ensuring financial stability.
Now let's focus on how the use of derivatives affect the profitability of airlines companies during the pandemic. First of all, let's take a look at the impact of the fuel hedging strategy. Fuel costs account for up to 40 to 50% of the operating costs in airlines. During the COVID-19 epidemic, global fuel prices has experienced drastic fluctuations, mainly due to reduced demand and supply chain interruption. This instability poses a major challenge to the financial situation of airlines. To deal with this risk, many airlines, including Air New Zealand, has adopted fuel hedging strategies to lock fuel prices through futures and options. In this way, hedged company can continue to enjoy the originally locked price, thus reducing the uncertainty of costs and improving financial stability. Specifically, Air New Zealand's fuel hedging strategy effectively protects its financial performance against the sharp fluctuations in global fuel prices caused by the post-COVID-19 demand recovery. This hedging not only helps the company maintain operation in difficult times, but also provides solid support for its future recovery. Next, let's take a look at the currency hedging strategy. Many airlines operate globally and use multiple currencies, so they are vulnerable to exchange rate fluctuations. By locking the exchange rate with foreign exchange forward contracts and options, airlines can stabilize earnings and costs to a certain extent and protect their profit margins. According to the 2021 financial report of Air New Zealand, the currency hedging strategy can help company reduce the negative impact of foreign exchange fluctuations and ensure that a certain amount of financial stability can still be maintained in the face of sharp decline in revenue during the pandemic. In summary, fuel hedging and currency hedging strategy not only help airlines meet the challenges during the epidemic, but also provide a guarantee for future financial stability. Through effective risk management, airlines can remain competitive in an uncertain market environment and achieve sustainable development.
Discussing how Air New Zealand's refined risk management strategy regarding fuel hedging and currency risk in response to the COVID-19 pandemic. Firstly, regarding fuel hedging, the pandemic reviewed an overhedging risk due to unexpected drops in flight activity. This will lead to significant financial loss. In response, Air New Zealand shifted to a more flexible hedging strategy. They now adjust their fuel hedging based on real flight activity. That will enabling the airline to manage costs effectively during period of flight to 18 demand and avoid excess expenses during downturns. Turn to currency risk management. We can see the pandemic also impact revenue in foreign currency, promoting Air New Zealand to revise its currency hedging approach. They adopted a dynamic strategy focused on major currency like US dollar and Australia dollar, and they're gonna use short-term contracts. This will allow for quicker adjustment in line with market movements, enhance both operation flexible and financial efficiency. In summary, Air New Zealand has effectively adapted its risk management framework to be more dynamic and response, ensure financial stability and resilience in a volatile global market. Those strategy adjustments not only mitigate risk but also position the airline for a more robust handling of future uncertainty.
Okay, here we go again. And this slide is about effectiveness of hedging strategies. The first is fuel hedging effectiveness. Historically, this has helped many airlines reduce costs during periods of high oil price. However, in times of sudden price drops, such as during the pandemic, airlines can suffer losses on hedging. The second is currency hedging effectiveness. As global travel pick up post-pandemic, currency hedging remains crucial for airlines that operate in multiple regions and have costs denominated in currencies like US dollar, while revenues may be in local currencies. The third is interest rate hedging effectiveness. This is especially important as global interest rates has become more violated. Airlines with effective interest rate hedging have managed to reduce financial risk associated with rate hikes. Last one is future outlook for the airline industry. Sustainability risks as the aviation industry face pressure to reduce carbon emissions. Some airlines may face rising costs related to carbon credits or compliance with emission regulations. Hedging strategies for carbon pricing might become a new area of focus. The second is technological advancements in hedging. As technology and data analysis improved, airlines adopting AI-powered risk management tools will likely enhance the precision of their hedging.
So finally, here we come to the reference list, and that's all. Thank you for listening.